All right, so hello guys. So let us start off this module of costing and budgetary control by looking at the first topic, which is Introduction to Cost Accounting. So this module has at least 14 chapters. So the first chapter is Introduction to Cost Accounting. So let us look at the learning objective of this chapter. So by the end of this chapter, you as students should be able to differentiate financial accounting and management accounting, understand the basic concept of cost accounting, classify costs in various categories, separate mixed cost into fixed and variable components, apply cost behavior in cost estimation. So at the end of the chapter, come back and see if you are able to answer and answer the learning objectives. So let's start off by talking about accounting is the main body, and under it we have two branches. We have the financial accounting and we have management or cost accounting. So cost accounting and management accounting are the same thing. So we cannot talk about cost accounting without knowing what accounting is. So accounting is all about recording, classifying, and summarizing transactions and events in monetary terms and interpreting the results. So the first thing is to record, capture the information. When you are recording the financial information, you need to classify them according to the purpose or whatever category you are classifying them by. For example, you cannot mix incomes and expenses. You have to classify and lastly summarize them like in form of financial statement. All transactions that have happened in a business in terms of money, right? You have to put every transaction in terms of money. 100 kwacha, 200 kwacha. And lastly, we should interpret the results. So we have already talked about accounting having two branches, financial accounting and management accounting, also known as cost accounting. So let us start off by looking at financial accounting. So what is financial accounting? So financial accounting is basically concerned with providing information to the external parties outside the organization. So what financial accounting is all about, we are saying that you have internal people, right? The directors, employees who run the business. And you have other stakeholders. You have the shareholders, customers, government, uh, lenders, suppliers, and so on, who are important. But because they are outside the organization, they don't know how the company is performing. So the people inside the organization are providing the external people with information of how the company has been run. So that's about financial accounting. So the main purpose of financial accounting is to provide a scorecard by which companies' overall performance is judged by outsiders. So you're saying you are giving the outsiders a scorecard. A scorecard is basically a card in which you are recording scores when it comes to sports, right? So you are being given this scorecard as a person who's not part and parcel of running the business for you to judge the company's performance, past performance, how the company has performed in the past, and you are able to record. I think it's performing very well. So that's the main purpose. The financial statement is providing that platform for you to actually make a judgment if a company is doing well or not. So that's the purpose. Then let's look at the other branch, which is management accounting, also known as cost accounting. So what is management accounting all about? So it's all about identification, measurement, analysis, interpretation, and communication of information used by management to evaluate, plan, and control. So you're saying you are analyzing information, you are interpreting information that is used by management. Management are internal people, right? So basically, management accounting is all about focusing on internal party rather than external party, which is governed by the financial statements or financial accounting. So this is helping them to plan, evaluate, and control. So let us look at the main purpose of management accounting. So management accounting is providing information to management for planning, control, and decision making. So it is giving information for managers, the internal people, to actually make informed and sound decision on how to run a company. So it's providing information to internal people, while financial accounting is providing information to external people. So let us look at the function of cost accounting. So the first function of cost accounting is determining cost and profit for an accounting period. So we'll be looking at how to determine a cost and how to come up with a profit of an accounting period. The other thing is creating inventory values for costing and pricing purposes. So we're saying that we'll be talking about how to cost inventory, how to price inventory. We'll talk about it in costing and budgetary control TC9. Helping management in making decision between alternatives. We'll look at the chapter of decision making. So you'll be there as a manager choosing between alternatives. Which alternative should I pick? So management accounting is very important for us as managers, right? To make informed decision of which is the best alternative. It helps in coming up and execution of budgets. So we also look at how to come up with a budget and how to implement a budget. And lastly, determination and analysis of cost and revenue of business enterprise. So we'll be coming up with the cost and analyzing the cost and revenues that an enterprise is faced. So let us look at the roles of cost and management accounting. So there are three main roles. The first one is to accurately ascertain the cost of goods and services. So costing accounting will help us to come up with accurate cost or accurate prices or cost. Second thing is it will help us to analyze actual versus budgeted. We'll look at this when we are talking about various analysis. And lastly, any other information that management feels that is important for them to make decision. So those are the roles. So the question might be, where do they find this information? How do they capture this information? So there is a system for it called the MIS. It refers to Management Information System. So this system provides data and information to managers to support in planning and decision making. It will give them information that they require for them to make sound and informed decision. So let us look at the difference between financial accounting and management accounting. So the first thing is financial accounting is reporting to the external, while management accounting is reporting to the internal party, which is the management. Financial accounting is mandatory. So all companies, limited companies, are required to produce financial statements, while management accounting is not mandatory. A company can run without management accounts, so it's not mandatory. Financial company must follow international accounting standards, so the ISAs. So we're talking about ISA 16 and so on. They follow those standards, while management accounting does not follow any accounting standard. It just does this thing. There's no actual standards that are guiding management accounting. Financial accounting will cover a period of 1 year, while management accounting can be prepared based on a daily basis, weekly basis, monthly basis. There's no actual time frame. But for financial accounting, we'll be covering a period of 1 year. The emphasis is on the past, because we're saying when you're talking about financial accounting or financial reports, are talking about financial statements that have already happened, things that have already happened, incomes of that have come already, and expenses that have already been incurred. While when you're talking about management, we'll be talking about to do with the future, right? To do with the future. And lastly, financial accounting only covers financial data. That means it will express everything into monetary terms. While management accounting does include non-financial and financial data. So somebody can argue that management accounting, maybe they are comprehensive, they cover a lot of areas. So let us look at some terminologies that will be used in cost accounting. We need to be familiar with. So we'll look at the term cost. What is a cost? So a cost, our name is expenses, right? Expense. So a cost represents consumption of resources. So the moment we are consuming a resource, it's like we are incurring a cost. So it represents consumption of a resource. Cost object. So when you're talking about a cost object, what is this? Anything where cost can be ascertained. So it's anything where we can establish a cost, right? Where we can establish a cost. So if I'm saying that Ilovo has those 1 kg packets of sugar, right? Based on those items, they can establish a cost for that item. So that one is a cost object. So cost unit, we are talking about a unit of product or services in relation to which cost can be ascertained. So we're talking about one item of a product or services where we can actually establish a cost. So cost unit is not the same as unit cost, because unit cost, we are talking about unit cost, we are talking about how much does 1 unit cost? How much does 1 unit cost? While cost unit, we are saying that which unit can we actually establish a cost to, right? So example, we're saying a cost unit might be a packet of sugar, right? A 1 kg packet of sugar. While a unit cost might be 800 kwacha per kg, right? So we're saying one packet will cost 800 kwacha. So that's a unit cost. So you need to know they are not the same thing. Cost center, a product or services location, a function, an activity or an item of equipment for which cost can be agreed. So we're saying that this is a department or a location where you are now accumulating all other costs. If you are failing to actually attribute a cost to a particular cost unit, right, or particular cost object, you just accumulated in one place, right? That's a cost center. It's a department. If you feel that I cannot actually say that this cost has been incurred by this cost unit, you accumulated it in one location. So this location is called a cost center, right? So let us look at an example so that we can look at what a cost unit is and a cost center is. So in terms of a university like maybe the Polytechnic University, what can be the cost unit? So cost unit can be a student per semester. How much a student is paying per semester? Maybe it's 500,000 per student per semester. So that's the cost unit. While cost center is, we can say, like cafeteria for investors where people can just go eat. Let's say library. Let's just talk about a library. We cannot actually trace the cost to one person because you don't know how much other people are bookworms. They go to the library often. Other people don't even visit the library. So you are not able to actually trace the cost to a particular person. So because of that, the library, you can just aggregate the cost of whatever costs are being incurred in the library in one location, being the library cost, right? You cannot actually trace it to one person that I know this student has gone to the library, so we are gonna charge him this amount. No, it's hard to trace in that scenario. So that's an example. So we can also talk about the hospital, right? Let's talk about colleges like the ones that are offering ICAM courses. So the cost unit is student, no, is subject per semester, rather, is subject per semester. So most of the time we pay like 25,000 per subject per semester. So it's not a student anymore because we don't pay per student. We pay how many subjects you are taking, right? Per subject. So those are the cost units. So you're supposed to be able to come up with a cost unit and be able to come up with a quotient. So that it's not like they'll ask you which is the cost center, which is the cost unit, but maybe in a scenario you're supposed to come up with that. But most of the time they will tell you this is the cost center, this is the cost unit. So let us look at elements of a cost. What makes up a cost? So a cost is made up of material, labor, and expenses. So material, we're talking about anything that goes into the in producing that object. So for example, if you are talking about coming up with a bed, we're talking about wood, we're talking about varnish, we're talking about nails. All those are materials. Labor, we're talking about human effort put into production of the product or provision or services. So in the same example, the bed, that means the carpenter putting his effort in coming up with the design of the bed. And the expenses, we are talking about anything used in the production other than material and labor. So if you are not classified as material or labor, right, you will be classified as expenses. So those are the elements of a cost. So let us look at classification of cost. How can we classify cost? So we'll classify cost in these four categories. So we'll classify it by nature, we'll classify it by purpose, we'll classify it by behavior, and classify it by function. So in each way of classification, we'll find categories. So let us start with classification by nature. So when you're talking about classification by nature, we can classify them in terms of material, labor, or expenses. So we can say, is this a material? Is this labor? Is this expenses? So those are the categories under classification by nature. So let us look at classification by purposes. So when I look about classification by purpose, we can actually classify them. Are they direct cost or they are indirect cost? Right? Direct cost is also called prime cost. Prime cost, while indirect cost are called overheads. So when we are talking about direct cost, these are costs that can be directly traced, attributed, or identified to its cost unit. So you are able to know that this cost unit has consumed this. We actually know that this cost unit has consumed this. For example, we're talking about the same bed. We actually know that this bed, a quarter-inch bed, will consume this amount of food. So that's a direct cost. While indirect cost are costs that cannot be directly traced, identified, or attributed to a cost unit. So we're talking about, you are failing to actually say which which of this cost can be related to the cost unit. For example, the same bed, right? We can be using electricity. We cannot actually know that how much cost did this bed consume in terms of electricity. Stuff like those. So those are indirect. So the thing is, all direct cost will be allocated to the cost unit because we know we can direct trace to it. So we'll allocate it to its cost unit, right? Cost unit or direct cost. direct cost unit. While those indirect costs will just be accumulated in a cost center because you cannot trace it. You just accumulate them first. After accumulating them, at the end of the day, now you can actually just divide by the number of cost unit you have produced. So that's how they are supposed to be handled. So let us look at classification by behavior, right? Behavior. So when we're talking about cost behavior, we are talking about the responsiveness of cost to change in activity level. So how responsive is a cost to change in activity? Is it too responsive or is it rigid? It does not change with change in activity level. So that's what we are talking about. So in terms of classification by behavior, we'll be talking about variable cost, we'll be talking about fixed cost, we'll be talking about mixed cost. So let us start off with variable cost. So what are variable cost? So we are talking about variable cost. We are saying that these are costs which change proportionately as the volume or activity level change. So they will change constantly, right? They will change constantly as the activity level change. So an example of it is fuel and mileage covered. So if you cover a longer distance, you will consume much fuel rather than covering a smaller distance. You also consume little fuel. So this should be taken in mind that all direct cost should be considered as variable cost. So all direct cost will be considered as variable cost. So whenever you have a direct cost, know that that is a variable cost. That means material is variable cost. So we're saying all direct cost should be seen as variable cost. So let us talk about this in more of a diagram. Let's talk about it in a diagram. So if I have a graph and I want to plot a graph, that means units and here cost, right? Total variable cost graph will go like this. We'll start from 0 because when there's 0 activities, you won't consume any cost. For example, if nobody has ordered a bed, you won't have to incur any cost because nobody has actually ordered any bed. That's why we're saying at 0 activities, the cost will also be 0. Because we're saying that it is a cost that changes proportionately or constantly. So the total variable cost graph is like this. So when you have one material, for example, one bed, maybe you use 20 kwacha. No, let's say 20,000. If it's 2 beds, right, it will be 40,000. 3 beds, 60,000. It's proportionate. While this is total variable cost graph. While cost per unit graph will be a straight line like this. Because what we are saying is cost per unit, right? We're saying, like for example, one bed is 20,000, meaning cost per unit is 20,000 over 1, which is 20,000. 2 beds is 40,000, right? That means cost per unit is 40,000 divided by 2, which is 20,000 as well. Same applies. 60,000. 3 beds will divide by 3 to be 20. So cost per unit graph will always be a straight line like this. It won't change. So it will be, for example, 20,000. So this is cost per unit, while the other one was total variable cost. So that's how the graph is supposed to be or look like. So when we are coming up with the graph, or when we are coming up with graphs in costing, we'll use the linearity assumption or the accountant's view, right? So when we're talking about the linearity assumption, we're talking about that we assume that cost or revenue will increase constantly, right? Cost stroke revenue will increase constantly, right? That's why our graph is formed by a straight line like this, because this is constant, right? Let us look at it in contrast with economist view. The economist view will assume stuff like economies of scale. Economies of scale. The moment you are buying in bulk, you get some discounts, right? For example, you might say, "Would 20,000 for one bed, 40,000 for two beds." But because you are buying three beds, they tell you that you pay 58,000. Maybe because you are buying four beds, you pay 75,000, because you are getting in bucks, right? You're buying in bulk. The way discount works. So the economist, their graph won't go like this, right? It will definitely go like this, because it is including economies of scales. So for us accountants, we will assume the linearity assumption going straight like this, while the economist, theirs will be curvilinear, right? Making a curvilinear assumption for economist. So that's one of the questions that do appear. What's the difference between the accountant's view and the economist view? You are saying that the economist will assume that these things to do with economies of scale, so their graph might go in a curvilinear. While for accountants, they assume that cost or revenue will increase constantly, meaning that their line will be in a straight line. That's why it's called linearity. Linear means straight. So let us look at fixed cost. So fixed costs are costs that do not respond to any changes in activity level, meaning that fixed costs are costs that do not change with change in activity level. For example, building rent. For example, rent of a building. If I'm staying alone in a 3-bedroom house in, let's say, for example, Namiwawa, and I'm paying 200,000 per month, if I'm staying alone, I'll still pay 200,000. If my friend comes in, staying 2 people, you still pay 200,000. If we are 5 people in the house, we still pay 200,000. It will not change, right? It will not change. That's why they are called fixed cost. It won't change because you are staying a lot of people in the house. That's a fixed cost. So this assumption that fixed costs will not change is only applicable within the relevant range. We'll talk about this just a few minutes from now. Or let's just say that the assumption that fixed costs will not change with changing activity level will only happen in the short run. In the shortest period, this assumption is true. But in the long run, fixed costs behave in a step. So let me just come up with a diagram. So we are saying that total fixed cost is the same. For example, the one for a building, that means here will be 200,000. So it will be in a straight line. If I'm staying alone, 1 person, 2 people, 3 people, 4 people, 5 people, it will still be 200,000 per month. That's the total fixed cost graph. Total fixed cost graph. While if you are looking at cost per unit, so cost per unit graph, will be like this. Why? We're saying that if I'm alone, I'm one person, that means I'll pay 100,000. If we are two people, we can split the cost and pay each 50,000. That means per person is 50,000. If we are three, we will pay 33,500. 33,333, like that. If we are four, we'll pay 25,000. Have you seen it's getting smaller and smaller? It's like you are disputing the cost. That's why the cost per unit of fixed cost will go in a downward shape like that, while total cost will remain constant like this. So the thing is, the assumption of total fixed cost will only apply in the short term. What am I saying? Or within the relevant range. Right? In the short term, this will apply like this. But for example, I'm living in a one-bedroom house. I'm paying 100,000. If my friend comes in, we'll pay 50,000, 50,000, right? That right? It will still be 100,000, right? If another person comes in, it will be the same until four people, and we say that I think this house is not enough. We need to go find a bigger house, maybe a 3-bedroom house. So a 3-bedroom house will cost much higher. So we're saying, for example, I'm staying in a 1-bedroom house. So I'm like 1, 2, 3, 4, 5, 6, 7 number of people. So I was staying alone in a 1-bedroom house. I was paying 50,000, right? When my friend comes in, we'll still be paying 50,000 until 3 people, and we say that no, this house is too small. Let us find a bigger house, which maybe will cost a 2-bedroom house, maybe will cost 100,000. So the cost will grow, right? But it will remain constant. Even if a friend comes in, it will be 100,000 until we reach a certain extent where we're saying that for 7 people, the house is too small. Let us find a 3-bedroom house. Then maybe that one is 200,000. Have you seen? It acts in a step in the wrong run. In the short run, we're talking here, right? In the shortest term, we're talking that fixed cost is constant. But when you look at it in the wrong run, fixed cost will behave in steps. So it will be fixed, then it will go up, fixed, then it will go up, fixed. So the relevant range is this period, is this range, another relevant range. So this is a relevant range. So let us look at what is defined by relevant range. So relevant range, we'll be looking at as is the level of activity or volume over which fixed costs remain constant without changing. So is the level of activity in which fixed costs will remain constant. So here we can see that it was constant. So this was the relevant range. Here it is constant. This is the relevant. So is the level of activity or volume of activities in which fixed cost will remain unchanged or constant. So that's what. So in the next video, we'll look at mixed cost and how they behave and how to separate this mixed cost and so on. So thank you.